Well, we've certainly got a good news story to report today. The Westpac Melbourne Institute Consumer Sentiment Index jumped by 6.2% to the highest level since August 2010. That's an extraordinary result, and I have to say, because I was expecting it to fall off a little. So why wouldn't it have fallen off? Well, when you think about it, it was taken after the end of JobKeeper. It was taken after we've been very disappointed with the rate of progress on the vaccine rollout, and of course the disappointing news about AstraZeneca. And yet it jumped 6.2%. So why is that so important for the economy? Well, consumer spending is about 60% of the economy, and the Westpac forecast for GDP growth in 2021 is an extraordinary 4.5%, which is much higher than the consensus view. But we need 3 percentage points of that 4.5 to come from the consumer. And the key factor there is that the consumer has accumulated a lot of savings, but they'll only spend those savings and reduce their savings rate over the course of this year if they're feeling very confident. And I think that's what we're seeing now. So that's given us comfort that the consumer will really lead us, will lead the growth story for Australia in 2021. So why was consumer sentiment so strong in the face of all those concerning news items? Well, it was clearly that the consumer was very, very encouraged by what's been happening in the labour market. So for February, we saw the unemployment rate fall from 6.3% to 5.8%, creating over 80,000 jobs. And this morning, after the survey, we saw the unemployment rate fall again from 5.8 down to 5.6, adding another 70,000 jobs. So the mood in the labour market is extraordinarily strong. We also saw vacancies up 27%. I think that's the really key factors behind this ongoing optimism. There are a couple of other quite important stories that were running through the survey. The first one was that there's 5 components to the index, but one of them actually fell, even though the overall index grew by 6.2%. One component was off a little, and that was the question, is now a good time to buy major household items? And the reason for that, I think, is that we're seeing this big pivoting going on between buying major household goods and spending on services. So last year, spending on durables was up over 11% as people were locked at home and buying a lot of household goods online. But of course, spending on services was down nearly 30%. So not only are we going to see very strong consumer spending this year, but we're also going to see a pivoting away from spending on big ticket items towards more and more spending on services. The other important story was around the housing market. So we do have a question which says, is now a good time to buy a home? That was down 7.8% in the survey, and it's now down 18.8% since the peak back late last year. So how can that be? Why is one sentiment index falling? And I think it's all to do with affordability in the housing market. So while people are looking at the explosion in house prices, first home buyers and owner-occupiers are getting quite unnerved about the fact that prices are moving so quickly and they're seeing their affordability being squeezed. On the other hand, we saw our index on house price expectations go to a 7-year high. And that's the one that's going to be bringing in investors, because at the moment investors have been lagging behind in this cycle. New lending to investors is only around 32% of new lending to owner-occupiers and first home buyers, whereas at the times when investors are really moving, that can be up to around 65%. So the story for housing this year is very clear from the survey that we'll start to see investors taking a more prominent role in the housing market. That, of course, is consistent with our forecast that over 21 and 22, house prices are going to be lifting by a total of 20%. What does all this mean for the Reserve Bank? The Reserve Bank is clearly very focused on the labour market, they're focused on wages, they're focused on inflation. Clearly, they'll now be lowering their profile for the outlook for the unemployment rate. At the moment, their forecast for the unemployment rate at the end of this year is 6%. We're already at 5.6% for March. Now, there will be some weakening as a result of the impact of the end of JobKeeper over the next few months, but they will clearly be lowering that number. On the other hand, they're also lowering their forecast for the full employment rate. We used to think that their forecast for full employment was around between 4.5% and 5%. We now think they're more comfortable with an unemployment rate in the high 3s or the very low 4s. So while the labour market is improving more rapidly than we expect, they're moving the target down. And I think that means they maintain their position that they're not expecting to see the full employment level be achieved and the wages growth of 3% plus and sustainably seeing inflation in that 2.5% range being achieved until that 2024 period. We'll wait and see what they say in their forecasts in May, but I think the story that's coming out now is that yes, a more rapid improvement in the unemployment rate at the moment, but Reserve Bank getting more challenging in terms of where they want to see that full employment rate. The other point, of course, is that remember that in August 2010, which was the last time we saw confidence at these levels, the Reserve Bank had actually increased interest rates over the previous year by 1.5%. As you know, that was just after the GFC, and the Reserve Bank said, well, the GFC is behind us, we need to now start normalising interest rates, and they rapidly raised rates 1.5% over a year. What happened then? Well, consumer sentiment in response to that and from those record levels collapsed by 25% over the subsequent year. Reserve Bank will remember that. They'll remember how important their interest rate policy is to consumer sentiment, and I think they'll be very cautious in terms of their response to this excitingly strong number and to the strength we're seeing in the labour market at the moment. Thank you.